Today we're going to study how a market bubble is like before it crashes. And we saw this pattern in the dot-com bubble as well as the '08 housing bubble. It rallied, the bubble popped, it retraced, and it crashes. And the '08 housing bubble, it rallied, the bubble popped, it retraced, and it crashes. And how about the debt bubble? And this setup suggests that we might be observing a bubble that has already popped. However, the recent numbers indicate that at least for now, a recession is off the books. So what is happening? And before we discuss about this topic today, please do take some time to read into the disclaimer. And there are three stages in recognizing a resolution of a market bubble. And what do I mean by that? It means that has the market bubble been resolved or if it is still ongoing. And what are the three stages? First, we have to recognize that what is the cause of the bubble in the first place. Followed by, we look out for sign of the bubble that the bubble has already popped. And number three is that we have to re-examine the cause again. Now, let's look at each example by starting with the dot-com bubble. And what is the cause of the bubble back then in the year 2000? And there was an expectation that there's a mass market adoption for online shopping. And many companies back then, as you can remember, they were overvalued. And that caused the bubble. But at one point, the bubble popped. It was because that the reality is that the technology is not there and there was no mass market adoption for online shopping, and that the bubble popped. Now, as it retraced, and that's the sign, number two, the sign of the bubble that have popped, it retraced, come to every point here, we have to re-examine back the cause. That is the market ready for an adoption for online shopping? And the answer is no at a point in time, and therefore the market continued to crash. Now let's look at the '08 housing bubble in this sequence. So what was the cause of a bubble back then, the stock market bubble? It was because of the housing, the private housing, and most of the houses were all-time high, and many homeowners are heavily leveraged on their houses, borrowed money, and that caused the stocks as well to move up. It's called a subprime crisis. Then the bubble prick, and that's point number two here, is that the bubble popped. Now, as it retraced, we got to look at the point number three, is that we have to re-examine the cause again. Was the subprime crisis being resolved? And the answer is no. As we retrace, it crashed. Now, I want to take note when the bubble popped, it pricked at about down 35%, and this bubble also popped down 35%. And there is a reason why the market moved down 35%, and it was massive. Now let's look at this debt bubble right now. And what was the cause of the rally, including the reason, you may call it the AI rush, but I will have to say that is a flow over of the balance of the easy money policy. But over the years, we could see that market has been exuberant, has been going higher, is a debt bubble that we are experiencing. But the debt bubble have already popped from my observation because it was down 37%. And if you still remember, when did it pop? It was at the beginning of the year 2022, and that's where we experienced high inflation until today. And the inflation have not been resolved, by the way. We have to understand that the debt produces inflation. Now, as it popped, as it retraced, we got to ask ourselves, point number three here is that we have to re-examine the cause. Is the debt bubble issue being resolved? And we got to come back to this point again, but let's look at the inflation. Again, debt produces inflation. And what we are looking at here is all the raw commodity prices. And something that you have to understand here is that before the agency published the CPI or the PCE numbers, they will require all this raw data. What I'm trying to say here is that all this raw data leads the inflation numbers. And what we're seeing here is that over the last 2 months or 3 months, I'm seeing that this is a monthly chart, and we can find all these prices in the CME market here. that the gold over the last 2 months has been aging up, and so is the light sweet crude oil over the last 3 months from about $60 region. Now it's $82 region. It may not seem a lot because we're looking at a very holistic picture here, but from 60 over to 82, that's quite a bit. And it may price into all the CPI and PCE numbers subsequently. And we're seeing the soybean oil. So is the soybean has been staying quite firm, and definitely the feeder cattle has been moving up, and the lean hog has been staying firm as well, except for corn futures. And the rice over the last 2 months has been moving up as well. And just to recap what's happening right now is that the debt bubble, and that's the cause of everything here today. But I would suggest that the bubble has already popped, and now we're moving into the retracement. And at this point, I will have to re-examine that is the cause of the problem being resolved, which is the debt bubble. And my answer is not quite. Now I'm looking for triggers. And what could be the triggers as it retraces? I'm looking for triggers like it could be the fundamental. And recently Fitch, the rating companies, have downgraded the bonds from AAA to AA plus. And that could be a trigger for the market to move down. And the trigger could be technical as well. Or it can be both technical and fundamental. And the question is this. So at this point, are you seeing risk or opportunity here? And my answer to that is that if I know there is a potential risk lying ahead of us, I am seeing opportunity. Now let me say this. Not knowing the risk, you are already risking most of it. Always enjoy studying the correlation between the markets and to uncover potential opportunities. And I hope today's sharing, it will be helpful in how you invest and trade. Feel free to leave any comments below. I love to exchange ideas with you. Really happy that you stay through this tutorial. You have many great trading weeks ahead.